Friends, in this video, we are going to discuss about the chapter risk management. First, what is the types of risk which are faced by the organization? There are various types of risk. First one is the strategic risk. Second one is the compliance risk, operational risk, and fourth one is the financial risk. What is the various types in the financial risk? We'll see. There will be the financial risk, counterparty risk can be there, political risk can be there, interest rate risk can be there, currency risk, and also a liquidity risk. These are the various types of risk that can be there in the financial risk itself. Okay, we will discuss this one by one. First, risk management. What is the types of risk which are faced by the organization? Strategic risk. What is meant by strategic risk? Strategic risk means the risk in which the company strategy becomes not effective, and they fails to meet the goals. That is called as the strategic risk. Whenever the strategic risk is a risk in which the company strategy becomes less effective and they are struggling to achieve the goals. This may happen due to the technology development, new competitor is coming into the market, or due to the shift in the customer demands, and also there will be the increase in the cost of the raw materials. There are various reasons the strategic risk may arise. For example, we can take the Nokia and a Kotak camera they have given. Okay, these are the various examples we can take as a strategic risk. Okay. Next, compliance risk. What is meant by the compliance risk? Every organization needs to comply with the certain laws and regulations. Certain areas of the rules, guidelines, and regulations will be there. If they fails to comply with that, they will be the liable for the penalty and also the imprisonment. So whenever they are venturing into the new business, whenever a company is venturing into the new business, there are various types of risk. That is the compliance. They have to comply with the rules and regulations. If they are not compliant, the compliance risk will arise. Okay, problem will occur. So that is called as the compliance risk. And then operational risk. Operational risk is the internal risk within the organization. Okay, within the organization, whenever the organization fails to meet the daily operational problems, for example, working capital may be down there. Okay, these are the certain operational risk which may be faced by the organization. This will be the people risk, or as well as the process risk also will be there. People risk, labor difficulties. Process risk means the machines may not work properly. These are the various types of operational risk that may occur. If they fails to meet their problems, means that is called as the operational risk. And then financial risk. Financial risk means unexpected changes in the financial conditions. Maybe the prices of the raw materials may go up, and also exchange rate differences will occur, credit rating, and also interest rate changes. These are the various unexpected changes in the financial conditions. Due to the change in the financial condition, this unexpected risk may arise. For example, the exchange rate, credit rating, interest rates, etc. This will cause the financial risk. And then financial risk itself, they have classified into further 5 types. First one is the counterparty risk. Second one is the political risk. Third is the interest rate risk. Fourth is the currency risk, and fifth one is the liquidity risk. First, we will see what is the counterparty risk. Counterparty risk means whenever the counterparty not honoring the obligations, either two parties will be there. No, one party fails to honor the obligations which are assigned to them. That is called as the counterparty risk. For example, the goods which are they are promised to provide, they are not providing, but a payment has been already received from the customer, or vice versa manner. Okay, these are called as the counterparty risk. And also second one is the political risk. Political risk means generally this type of risk will be faced by the overseas investors. Overseas investors means whenever there is a change in the government in the foreign country, there will be the problems for the investors who have invested in the foreign countries. So overseas investors can the political risk on the arise. This will be the foreign country government can take the adverse action. Any adverse action that may lead to the huge losses. Okay, for example, confiscation of the overseas properties, rationing of the remittance means they should not remit more than this amount. Like that, they can rationing the remittance. Restrictions on the conversion of the local currency into the foreign currency, restrictions on conversion of the local currency to the foreign currency, and restrictions on the borrowings, and invalidation of the patents, price control of the products. Okay, but we can remember this as CRP, confiscation of the properties, rationing of the remittance, and the restrictions on conversion, restrictions on the borrowings, And also P for the invalidation of the patents or invalidation of the patents, price control of the products. These are the various risks which may arise due to the political risk. Third one is the interest rate risk. Due to the interest rate changes due to which the assets and liabilities value also will changes. Okay, asset and means because of the exchange rates will change. If the interest rates changes, means the exchange rates will change, so that the assets and liabilities value may go up or go down in case they have the foreign investments and all. Okay, so this is called as the interest rate risk. There will be the two types of interest. First one is the fixed interest and the second one is the floating rate of interest. So a fixed rate of interest now it will be whenever the floating rate of interest goes down now, fixed rate interest assets and liabilities will be go up. Okay, so whenever the floating rate interest go up means wherever the assets and liabilities which are in the floating rate, that value will go up. Okay, but liabilities also will go up. So that is only they have given. Interest rates are of two types, which is fixed and floating. The risk in both of these types are inherent. If any company has borrowed money at a floating rate, then with the increase in the floating, the liability under the fixed rate shall remain the same. This fixed rate with the falling in the floating rate, the liability of the company to pay the interest under the fixed rate shall be comparatively higher. So floating rate change the assets and liabilities value will increase or decrease. Okay, currency risk. Next is the currency risk in the financial risk. Like currency risk whenever the organization dealing with the foreign exchange, the cash flows will changes based on the changes in the foreign currency exchange rate. So that is called as the currency risk. And finally the liquidity risk. Liquidity risk means whenever the company is not able to meet its liabilities, that is called as the liquidity risk. That is called as the liquidity risk. Okay, so how we has to evaluate this financial risk. Okay, we have completed the various types of risk. First one is the strategic risk, compliance risk, operational risk, and fourth one is the financial risk. In that financial risk, there are 5 types of risk: counterparty risk, political risk, interest rate risk, currency risk, and liquidity risk. Okay, liquidity risk. Next, we has to go how we has to evaluate the financial risk. The financial risk can be evaluated from the different points of view, from the stakeholders' point of view, and also from the company's points of view. Stakeholders of the business or equity shareholders, they will view the financial gearing, that is ratio of the capital structure of the company, as a risk. Since in the event of winding up of the company, they will be least prioritized. Everyone in the financial risk on the shareholders papangana, if the debt is more in that company, debt வந்து நிறைய இருந்துச்சுன்னா, then they will fear to invest in that company, because at the time of winding up, that every assets will go to the debenture holders only. So if financial risk can be seen from the shareholders point of view based on the capital structure. And company points of view, from the company point of view, if your company borrows excessively or lend to someone who defaults, then it can be forced into the liquidation. Means they should not lend or borrow from the person who defaulting. Okay, who is doing defaults. Okay, so they should not borrow or they should not lend from to that person who is doing the defaults. That will lead to the liquidation. That will be the financial risk in case of the company point of view. From the government point of view, financial risk can be viewed as a failure of any bank or a downgrading of any financial institution. This will leads to the lack of confidence. Means this will lead to the minimize the confidence in the view of the investors. Okay, so this will disrupt among the society at large. So if the bank got liquidation, or bank some borrower has borrowed money and they not repaid, now bank got failure or liquidated, means then people will fear to invest in banks. Okay, but it will be treated as the financial risk in the viewpoint of the government. Okay. Then value at risk. Value at risk now, what is the? It is the risk of the investment. How much is the, means if you are investing in any investment now, what will be the worst case scenario? What will be the maximum loss that can occur during the certain time period? What is the maximum possible loss? That is called as the value at risk. Okay, what is the worst case scenario and what will be the loss? What is the worst case scenario and what will be the loss? That is called as the value at risk. And what is the features of the value at risk? Okay, there will be the 3 components will be there to identify the value at risk. First one is the time period, means say 1 day, 1 week, like that. Time horizon will be there. Time period, confidence level confidence level, it is 95%, 99% confidence. At a 95% confidence level, how much is the maximum possible loss? At a 99% confidence level, how much is the maximum possible loss? This or the confidence level will be there, and the loss in the percentage or the amount at this confidence level means how much loss can occur during a particular day, during the particular week. If we invest this much amount in this security, what will be the maximum loss? That is called as the value at risk. What is the components? There will be the time period, confidence level, and a loss in the percentage or the amount. These are the three components will be there in case of the value at risk, and they will be using the statistical method. Standard deviation will be used in that, and a time period means say 1 day, 1 week level loss agla, 1 month level loss agla, it can be calculated, and they will be using the probability. What is the possibility of occurring the loss? That they will be using the probability and also risk control means if the risk on the limit பண்ணுவாங்க, maximum risk which can be taken by the investor, அந்த risk level வந்து அவங்க limit பண்ணுவாங்க. So risk control will be there, and Z score na how much is the standard deviation from the mean value, average ல இருந்து எவ்வளவு standard deviation ஆகுதோ, that will be called as the Z score. இதெல்லாம் யூஸ் பண்ணி தான் வந்து we are calculating the value at risk. Okay, application of the value at risk. How value at risk will be applied for identifying the maximum possible loss to keep the benchmark for the performance measurement, and also this can be used for the how the set the limits for the individuals, how much risk they can take, they can keep the limits on that. It will analyze the trading strategy and asset and liability management. For this purposes the where can be applied. Okay, next, appropriate methods for identification and management of the financial risk. Okay, there are various methods. There are various types of risk we have seen. Various types of financial risk we have seen. What are the risk we have seen? Counterparty risk, political risk, interest rate risk, currency risk, liquidity risk. These are the various types of financial risk we have seen. Okay, so in that risk, how we have to identify the risk and how we are going to manage this risk. That is the next part of discussion in the financial risk. Okay, so first counterparty risk. Counterparty risk enna hints. Okay, what all the area means if these things are not happening na, that is called as the counterparty risk. First, failure to obtain the necessary resources. If any party we has to provide the goods or we has to provide the services, but we are not even getting whatever the resources which are required from that customer, okay, or money, they are not obtaining the money. I mean, so that means the counterparty, any one party is going to fail. That is called as their failure to obtain the resources from the third counterparty. That is the counterparty risk. And also any regulatory restrictions from the government or any hostile action by the government, means foreign government is doing any hostile action, any bad action from the to the person, then let down by the third party itself leaving, or they become insolvent. These are called as the counterparty risk. 2 points are relating to the government and 2 points are relating to the third party. Okay, so failure to obtain the necessary resources, regulatory restrictions by the government, hostile action by the government, and also let down by the third party or insolvent. These are the examples, these are the areas which can counterparty risk will happen. Okay, how we has to manage this risk? Everyone the manage panna before entering into that project or before entering taking up that customer, we has to perform the due diligence. Due diligence means we has to a prudence activity which has been performed by a prudence person under the certain circumstances. Before entering into the project, they has to analyze about the project, whether that parties confidential or not. That and all we has to analyze. That is called as due diligence. Or we has to get the performance guarantee. Performance guarantee can be obtained from the person. And also limits means we should know our exposure limits and what is the credit rating limits which has been provided by the credit approval authority. That and all we should know before entering with the project with the customer. We should know what is the credit rating they have provided, and also we should know our exposure limits. And also we should what is the action we can take if they have defaulted, means what is the action we can take. We should not overcommit ourselves. These are the areas we can minimize the counterparty risk. Okay, what and all we can do the due diligence, or we can get to the performance guarantee. We should know our exposure limits, and also we should review the limits which has been provided by the credit rating authority. Credit approval, what is the credit approval authority provide the limit for that customer, And also what is the rapid action we can take in case of the livelihood of the defaults. These are the things we can do to minimize the counterparty risk. Then political risk. Political risk means insistence on the residential investors or the labor, resident investors or labor. Counterparty risk can be done by the governments of the host country. Means any foreign country government action can affect the investors. Okay, that is called as the political risk. So they can keep the restrictions for conversion of the currency. They can take over assets, expropriation of the assets, foreign assets by the local government, price fixation of the products. These are the things which can happen. The political risk. Okay, insistence on the resident investors or labor, restrictions on the conversion of the currency, expropriation of the assets means they are taking of the assets, and also they are price fixation of the products. These are the political risk, and how it can be managed means we have to see the political ranking, whether we can invest in the country or not, that country is safe or not. We have to see the political ranking, and we have to note on the knowledge about the macroeconomics and what is the current government, whether what is the stability and what is the popularity we should know. And also we have to get the advices from the embassies of the host country who are in the home country. Means there will be certain embassies of our home country, there will be in a host country. Means foreign country la nammaloda embassies, நம்ம home country oda embassies will be there. We have to get their advice what about that country. We have to get the advice from them before investing in that country. Okay, next some more they are techniques to mitigate the risk they have given. What and all means we can procure the raw materials locally itself, or we can enter into the joint venture. We can get the local financing itself, and also we can do the negotiations and all. These are the certain areas we can do the mitigate the political risk. Okay, mitigate the political risk. Then interest rate risk. Interest rate risk means the interest rate risk mainly identified from the following. First, monetary policy of the government. What is the monetary policy they are following? Demonetization, anything happened? Any economic growth? What is the economic growth of that government? These are the interest rate risk we can see. And also investment by the foreign investors. How much foreign investors are investing in that country? Stock market changes. What are the stock market changes? From this we can get the interest rate risk. Okay, by interest rate risk possibilities we can identify that. And release of the industrial data. About the industrial what is the data, whatever the industry we are going to invest, we have to get the industrial data. These are the interest rate risk. The management of the interest risk has been discussed in detail in the separate chapter later on. Okay, interest rate risk management la and the chapter la solirpaanga. Currency risk just like the interest rate risk, the currency risk is dependent on the government action and also economic development. We have to see what and all the some of the parameters to identify the currency risk or as follows. What is the nominal interest rate? What is the government action which has been taken by and what is the impact on the currency? Like whatever the plans of the government. If there is changes in the government means if they impose any new policies, that and all we have to see in case of to identify the currency risk. Okay, government action, nominal interest rate, how much is the nominal interest rate, what is the inflation rate, if there is any natural calamities which are happening in the country, war calamities, and also changes in the government. If there is any change in the government, these are the areas we have to concentrate to identify the currency risk. Okay, currency risk also, the management of the currency risk also separate chapter has been discussed. Okay, so this is about the risk management chapter theory. Okay, first we see that there are 4 types of risk. First one is the strategic risk, compliance risk, operational risk, and then financial risk. Strategic risk, compliance risk, operational risk, and then financial risk. Financial risk has been divided into 5. First one is the counterparty risk, political risk, interest rate risk, currency risk, and then liquidity risk. Okay, what is meant by value at risk? Value at risk futures has been given. Futures of the value at risk, now it is the maximum possible loss. Value at risk means it is the maximum possible loss during the particular period, time horizon. During the time horizon, that is called as the value at risk. Maximum possible loss that in any type of investment, risk of investment, that is called as value at risk. What is the features of the value at risk? Components of the calculation, statistical method, time horizon, probability, risk control, and then risk control and Z score. And what is the application of the value at risk? It is a maximum possible to identify the maximum possible loss, or to set the benchmark for the performance measurement, limits the limit. It will provide the limits for the individuals. Trading strategies will be provided by them, and asset and liability management. These are the application of the value at risk. Okay, we have done with the risk management chapter.